Hello, everybody. Thank you for joining us today. Please don't hesitate to share in the chat where you're joining us from. It's always interesting to see from how many diverse places you are joining. Let me start. Welcome to our today's webinar on the latest developments on the Nature Finance Nexus. My name is Magda Zachara. I work as a program officer at the IUCN Academy, and I'm based at the headquarters in Gland, Switzerland. I'm supported today by Rose Moriti, a program officer in the Academy team who is based in the IUCN Nairobi office. And today's webinar is going to be facilitated by Professor Jorge Viñuales, who is going to discuss with our expert speakers, with Dr. Frank Hawkins and Shizuka Onishi, our IUCN colleagues, as well as Daniela Vernazza from Impact. And I also wanted to take this opportunity to mention that Jorge is the course director of the IUCN Academy Professional Certificates on Finance for Nature, which is an educational program designed to help equip participants with understanding and more proficiency and practical approach to the major concepts of the nexus of nature and finance. And we are actually going to kick off a 4th edition of this program at the beginning of the new year, 13th January 2025. It is a blended program that lasts 5 weeks and that is composed of self-paced e-learning with 12 hours of online sessions led by Professor Jorge Viñuales and our expert speakers. And I will be happy to say a few more words of detail about this course. But for the moment, I will give the floor to Jorge to start the discussion on our today's topic. Thank you.
Thank you very much, Magda. If everyone can hear me, hello, everyone, and welcome to this webinar on essentially the latest developments on the nexus between nature and finance. My name is Jorge Viñuales. I'm a professor at the University of Cambridge, and I collaborate with the IUCN Academy in this course and in some other ways. And it's a great pleasure to be here with you in this remote room and with a panelist, which I will introduce in a moment as we speak and as we introduce the topic. So just at a very broad level, the broad topic that we want to address today is this nexus between nature and finance, or finance and nature. And the nexus is something which is quite complex, but it has been mapped and developed and explored and increasingly refined in a range of instruments, in a range of approaches. Most people will have heard about natural capital. Most people will have heard about ecosystem services, and most people will have heard about the issues of disclosure, the issue of nature positive business models, the issues of biodiversity credits. But there are many different issues that arise in this interface between nature and finance, and we would like to pick a few and put them on the table, discussing them with our experts, and then just taking questions and trying to engage in a conversation with the attendees here. So the approach will be a bit, we will put some things on the table, really just to unpack the basics of these issues, and then we will be happy to take questions. I will try to moderate taking batches of 3 questions each. And the idea really is to ask questions about the presentations or about related topics. So it's really to take advantage of the people in the webinar to ask different questions. Some may be presumably about the results of the COP16 in Cali that has just come to an end. But not only because there are many different areas of interest in this space. So with that as background, I would like first to turn to Daniela Vernazza from Impact, So Daniela is a sustainability expert with in-depth knowledge of regulatory frameworks for financial and non-financial institutions. She has helped the tech startup Impact to collect and analyze impact data, enhancing accountability. She has originally a background in journalism, and her expertise supports the growing momentum for transparency in environmental, social, and governance, the famous ESG areas. So, Daniela, if I can turn to you now for your brief introductory remarks.
Yes, thank you so much, Jorge. So as you introduced me, I've been working with Impact and helping companies implement the CSRD, which is the Corporate Sustainability Reporting Directive, which recently entered into force. We are expecting companies to be reporting, fully reporting on the new reporting directive for next year. This will entitle around 50,000 companies expected to report. Of course, companies will report depending on their size, and they will be introduced to the reporting according to their size and the number of employees and other very specific details. But I just wanted to touch on how standardized sustainability disclosures are enhancing comparability, and this directive really looks forward to solidify and standardize what the disclosure should be for undertakings and companies. It is based on the concept of double materiality, which takes into consideration how companies impact the society, the environment, and governance issues as well, ESG, as you were saying, but also how these issues potentially impact the company. So it takes a double materiality approach, both looking at how it affects the environment, but how environmental changes or social disruptions also affect the company in a financial ways. This allows companies to evaluate both their environmental and social impact, as I already mentioned, but also how their business model might be at risk, considering all of these varied environmental, social, and governance factors. The concept of double materiality and what the CSRD regulation requires for companies is very interesting, considering that the reporting is focused not on all the relevant sustainability matters that might be relevant either from an impact point of view or a financial point of view, but just the ones that are material. So the concept of materiality is there to really filter down what companies are disclosing and really forcing them or inviting them to report on what is most essential to their operations. This is very important to also increase transparency and also increase the focus, which becomes even more important when it comes to engaging with stakeholders and stakeholders knowing about how the most material ways in which companies can also affect them. So this regulation also requires assurance and is mandatory for European companies and for those companies that have material, material operations in the EU. And these require mandatory. The fact that it's mandatory and that it requires assurance also strengthens credibility of the data provided. Well, I don't know if I have more time because, but I'm gonna touch briefly on a few set of points I also wanted to raise. The corporate sustainability reporting standards were also created with the CSRD. This is a set of principles that help compliance by companies. It is composed of around 300 data points across environmental, social, and governance topics. There are 10 sector-agnostic topics that EFRAG, which is the organization that has drafted this regulation, has specified. Sector-agnostic means that it applies to companies across all industries. We are expecting more detailed mandates from EFRAG in the following years, depending on the industry the company is working. But again, these very specific data points across the 10 topics, big sector agnostic topics, also cover how the impacts, risks, and opportunities, impacts being how the company impacts the environment, social, and governance aspects, and risks and opportunities being how the environment, social, and governance aspects affect the company. So these data points range across how companies manage these impacts, risks, and opportunities, their governance around their impacts, risks, and opportunities, some key metrics and targets, which is very important when it comes to measuring the actual impact and the actual impact of companies on the environment, and on also how the environment affects companies, and also strategy, which is very important when it comes to integrating these environmental, social, and governance topics into how a company runs its business model. And I would like to leave you, and maybe this will be good to introduce the following aspects of the webinar. The Corporate Sustainability Reporting Standard also mandates companies to consider its value chain, which is something that's, let's say, new. So companies must not only evaluate their own impacts, like their direct impacts that arise from their direct operations, but also how their value chain suppliers or business partners are also affecting the environment, social, society, and in governance ways. So it extends beyond what the company, like the company's strict boundaries. And this also ties up with the new CSDT, which has just entered into force in July this year. And the CSDT is the Corporate Sustainability Due Diligence, and basically mandates and standardizes how companies must also consider the due diligence process in their value chain. So it requires companies to conduct due diligence of their business partners, as mentioned above, and it also requires companies to identify and assess actual and potential human rights and environmental impacts outside of Europe, which is very interesting into how business that are global or integrated or depend their global supply chains on other external external countries from the EU also need to make sure this is integrated into other jurisdictions. I will leave the floor to the next speakers because I think I already mentioned a lot, but happy to continue the conversation in the questions.
Thank you very much, Anina. And indeed, it's so just to try to transition to the next presentation by Shizuka. Globally, there is a trend towards requiring disclosure, essentially requiring companies to collect and report on information about certain aspects of their sustainability implications. And what you mentioned about double materiality, which is quite opposed to other approaches that are the single materiality approach, this is really a fault line between jurisdictions, with some jurisdictions, the majority of them, unfortunately, going for single materiality, which means essentially that a company would have to gather information and report only on those impacts of nature on the company, not the company on nature, that may threaten the financial performance of the company. And whereas the double materiality that you're mentioning, and that is quite at the heart of the reporting system of the European Union, is looking at both sides of the equation. And it's even going beyond, as you were mentioning earlier, which is disclosure is one thing, right? But the recent trend towards due diligence, both domestically and now internationally, or at least at the regional level in the EU, is important to look at the business model. So companies are no longer simply able to get away with it by collecting information and reporting it. They now need to really take that information into account when they design and conduct their business. And with that very brief transition, I would like to now turn to Shizuka Onishi from IUCN. Shizuka is part of the IUCN's Blended Finance Initiative that looks at mobilizing private finance for nature in collaboration with the Green Climate Fund, the Global Environmental Facility, and the Central African Rainforest. And Shizuka is going to talk about the nature positive approaches, particularly the UNEP one that has been published recently, and hopefully that can take us a bit more into the business model issues. Shizuka.
Hi, thank you, Jorge. Hello, everyone. I'm joining from my phone because of my PC issue, so sorry about this video format, but I hope you can see me and hear me. Well, so as Jorge said, there are several institutions working on business models towards financial sector's alignment with the Kunming-Montreal Global Biodiversity Framework. But since UNEP-FI and the Finance for Biodiversity Foundation has just published a discussion paper on the working model for Finance for Nature Positive, I thought it might be interesting to look into this model together. I think it's been released just over a month ago, and the discussion is still going. They're collecting feedback, and there's going to be further work on more detailed structure of the framework. But just from my view, what I understood that this working model by those institutions are trying to do is that we're starting from really the nature positive goal, which is to halt and reverse biodiversity loss by 2030 on a 2020 baseline. So that's where the starting point is. And by saying that, I realized that 2030 is really just a few years away from us. So there's really immediate action that needs to be done. And in that sense, the financial sector is really looking into more guidance as to how concretely we can align the financial flow with the global goal. And there's also a key element of the new global biodiversity framework that wasn't in the previous one, which we called Aichi targets, if you remember. That is under the goal D, means of implementation. There is target 19 that strives to mobilize financial resources from all sources. So traditionally, under the previous global biodiversity framework, we looked at international public financing. So that typically flows from developed countries to developing countries. And we also looked at domestic public funding within each country, but private funding, be it international transporter or domestically, it's something that has been added as a new element. And that's why we really need to understand what is the finance that we're talking about and how we are going to go about to achieving the goal. So in that sense, this working paper focuses on 2 points. So one is the what part, so the definition of nature positive finance. And then the other part is how part. So how are you going to achieve transition into nature positive finance sector? So the first part, definition, this actually stems from the international public funding tracking system, because we used to have before this Kunming-Montreal framework, we were tracking the public international funding and domestic funding under the previous framework. So we did have some kind of structure and tracking mechanism that we could build on to fine-tune and adapt to the new goals and framework. So what they did is they look at the World Bank Group's definition of nature positive finance. So they distinguished, first of all, the nature impact mitigation finance, which is financing operations that really comply with the international safeguard policies, so do no harm principles, and especially complying with the conservation mitigation hierarchy, which is really, really important to safeguard biodiversity. So there's a order that needs to be followed in terms of how to avoid negative impacts to the biodiversity and then minimize, restore, and offset. So first of all, we need to strive to avoid any negative impacts to biodiversity if possible. So that's the mitigation, what they call nature impact mitigation finance. And then if we are funding operations that are enabling transitions towards nature positive goals, then that would become nature finance. And here they also define two types of finance, whereas the financing operations that is expected to deliver measurable positive outcomes, so measurable is the key, then that would be qualified as a nature positive finance. And if not, that could be qualified as a nature mainstream finance. So that's the definition part. And then they also discuss what are the strategies to shift the financial institutions' portfolios away from negative impacts to positive impacts. So again, we're talking about two things. So here, first of all, reducing the negative impacts to the biodiversity, and secondly, to increasing the activities that would contribute to biodiversity positive impact. So those two are interrelated, although different. So the working paper suggests some approaches in how to shift those two streams of financial flows. First of all, to avoid or engage in reducing key negative activities. So that could be, for instance, financial institutions integrating a new investment criteria that would exclude investing into negative impact activities, or working with the investees so that they apply stricter environmental and social safeguards, or investees to have more robust pathway to their business operations achieving net positive. And then in terms of generating biodiversity gains, this can mean, for instance, identifying or developing conservation restoration project opportunities and developing an investable portfolio, or looking into conducive financial instruments, such as the sustainability-linked bonds and loans, or impact investing, blended finance, the use of payment to ecosystem services. So from my view, I took three important observations from this working paper. I'd love to hear, if anybody has read this working paper, your views on this. But for me, there are three key observations. So first of all is that we are acknowledging the importance of addressing financial flows with negative impacts and how to change it, because the current trend is that we are depleting biodiversity, we are sending more species to threatened species status, we are degrading more ecosystems. So that means that we are having more operations that damage biodiversity than creating positive impacts. So we really need to understand the magnitude of the negative impacts that we're having, and we're trying to shift the current financial flow from there. But we are having this issue even though we have the robust international safeguard framework and policies and guidelines. So I think there's a lot more to think about why we are still having this phenomenon of having a tremendous negative impacts on biodiversity, and what needs to be done to reverse this trend. So that's one point. The second point is this proposed working model actually brings together all the other existing tools under development on disclosure, how to measure nature and biodiversity, what are the metrics, what are the approaches to target setting, what are the financial instruments that we can use to stimulate those transition to nature positive finance. And the paper actually helps us understand how to use these tools in order to make actual changes in financial operations. So it's not something that is out of nowhere or disconnected from all the instruments that we're talking about. It's a whole ecosystem and the tools that we need to. We do have the opportunity to harness those tools and knowledge products in order to achieve the transition into nature positive finance. The last point I want to make is the importance of technical assistance and capacity building. So in order to have those transitions, there's a lot of knowledge and capacity reinforcements that needs to be done. For instance, in terms of structuring nature positive financial instruments, how to design so that they are robust, high integrity, and high impact. We also need development of pipeline. This is one of the core issues that we are facing in terms of mobilizing financing into nature, that we don't have investable projects with financial returns and scale that would cater to private capital interests. And also how to measure biodiversity impacts based on, for instance, site level data. This goes both for investees and investors, so there's a lot of scientific and technical knowledge that is required to enable this financing for nature positive. So I also want to say that this is particularly relevant for developing nations, because I think Daniela also mentioned in her last remarks that there are operations that are actually impacting biodiversity in outside EU and other developed nations. Most of the biodiversity hotspots are located in developing countries. And unless we have enough capacity at the local stakeholder level, if we introduce more and more regulations, international norms, reporting requirement, target setting requirement, without equipping the relevant actors with the capacity that they need, then actually this would not work. So I think there's a lot of efforts to be done in terms of technical assistance and capacity building. IUCN Academy, which is hosting this webinar today, is one of those efforts where we really need to think how effectively to deliver those technical support and capacity building support to the most relevant stakeholders. So those are my takeaways from this report, and happy to discuss more. I hand it back to Jorge.
Thank you very much, Izuka. And indeed, there is a wealth of metrics, standards, guidelines, and even institutions and ecosystem, as you mentioned, of service providers that can help companies just repurposing or rechanneling, or at least adjusting their processes to make them nature positive. One aspect that always comes up once we have discussed the issue of disclosure, which is just about information, and then the issue of adjusting your business model to make it less impactful on, negatively impactful on the environment, is the issue of how can finance secure a profit from actually investing in nature. And that's a big issue that you mentioned as well. I mean, there tends to be a sort of trade-off between scale and depth. By scale, I mean you can secure financing at a lower rate by issuing green bonds, for example, or securing a green loan if you stick to some standards that are widely recognized and then are monitored. But that's not necessarily the type of financing or financial return that the investor would be trying to achieve. Of course, investors would be getting the return from that loan or that bond, but that is not exactly what we're thinking about when we talk about investing in nature. So there is a sort of an area where where biodiversity and nature finance is not entirely developed, and a lot is being extrapolated from carbon finance, and particularly the idea of carbon credits. And we have seen already that there are a number of questions there. But before we turn to those questions, let me introduce our third speaker of today, Frank Hawkins from IUCN as well. Frank is a conservation biologist and a policy advisor with many years of experience working with governments, financial institutions, civil society, and local communities in Africa and around the world. He's currently a policy and finance advisor in IUCN, leading the development of IUCN Nature Positive approach. Frank focuses on the use of natural capital data in investment decision making and on bringing the conservation and finance communities together to drive changes in international conservation. Frank is going to address a bit more the issue of biodiversity credits. Frank, you have the floor.
Many thanks, and very useful to be able to build on what the previous speakers have said. I'm going to talk to you very briefly now about biodiversity credits. I see there's some questions on that subject already that have come up. I did prepare a couple of slides, which are probably more useful to me than they are to you, but I'll share them on the screen if I'm able to do so. Let me try. Are you able to see that?
Yes.
Good. So biodiversity credits are something that's become one of the great kind of talking points whenever you get people in a room together talking about investing in biodiversity or financial flows in biodiversity. And they tend to suck all the air out of the room. People always want to talk about biodiversity credits because they have been proposed as something that will solve the problems of generating enough cash to make biodiversity management an appropriate mechanism. So what I want to do today is to investigate a little bit the reality of that situation, and in particular to start with one definition of what a biodiversity credit might be. So the Biodiversity Credits Alliance is something that has been emerging recently that has tried to lay out a definition that can be used by people who want to enter this world in order that there's a general level of understanding about which we can agree the definition. So a credit is a certificate. That's to say, it's a thing which has some kind of validity given to it by an agency, which is a certifying agency. And it represents a measured and evidence-based unit of a positive biodiversity outcome that is durable. That's to say, it lasts for a long period of time and is also additional to what would otherwise have occurred. So the idea is that you're putting money into an outcome that changes the status of biodiversity, and that you are then able to have a certificate that recognizes your delivery of that unit, and that you can then, in theory, trade that unit on an international market or domestic market, actually. And the biodiversity outcome consists of three different possible ways of achieving the outcome. First of all, you can deliver uplift, and the uplift can be improvement in the status of ecosystems or species in terms of recovery of species through reduction in threats or reforestation of threatened habitats, or other kinds of activity which relate to reducing threats to ecosystems and species where those things have occurred in particular places. You can also, in theory, generate a biodiversity outcome from avoided loss in much the same way as you do for a carbon emissions project, a land-based carbon emissions project, where you're maintaining the integrity of an area based on its history, but also based on the fact that there are pressures that apply to that area in the surrounding landscape. So you're making those threats less likely to occur in the place you're working. That the third component of these outcomes is to do with how you generate this avoided loss, and you either do that through maintaining the effort you provide in managing a site, and this is known as stewardship, And it's particularly important if you want to involve indigenous communities and local people in a biodiversity credits market, because in many cases they are constituents who are working in areas of high biodiversity value, and what they want to do is to continue doing what they were doing before. So generating a unit of yield for an activity that is going on, continuing from the past, is a less simple thing than just improving the status of the biodiversity in an area by reducing the pressures or re-establishing a habitat. A really important thing is that these biodiversity credits have to be measured and evidence-based. That's a very tricky thing to do if you're dealing with efforts to improve the status of ecosystems when you might have 5,000 ecosystems around the world. How can you define a mechanism for generating uplift in all 500 of those ecosystems? They need to be long-term in order that the outcome you're generating actually is continuing into the future. Often very difficult to do. You can't just do it on a project basis over 3 or 5 years. You've got to do it over 30 years. And this means that you need to depend on sources of finance that are available for that length of time. And obviously there's the additionality issue, where you have to demonstrate that what you did is in addition to what it is that would have happened if you hadn't done the work. And in many cases, that's quite a hard thing to do. You have to demonstrate that what you did was changing the pathway of, for instance, say, a deforestation frontier, but that you did it in such a way as you can show that you were the people who actually made that happen. So those are sort of the general context around biodiversity credits. The reality is that there are a number of very serious issues associated with biodiversity credits at the moment that really haven't been resolved. They are under discussion. There are 2 places you can go to get much more information about this. One is the International Advisory Panel on Biodiversity Credits, or IAPB. The second is the Biodiversity Credits Alliance, the one I've just already mentioned. There's lots of material you can use from both of those websites that will explain these issues in more detail. The first one is that the general agreement, although it's by no means unanimous, is that biodiversity credits, that is to say, the ability of a company to buy a positive impact on biodiversity units, should not be the same as a company delivering its obligations under the mitigation hierarchy, and in particular, using offsets to create an additional impact on biodiversity that is used to offset the negative impacts that company might have had. The premise, and it's, as I say, by no means completely accepted, is that a biodiversity credit has to be additional to that. So that's one issue that people are wrestling with at the moment. It's hard to find cases where you can genuinely show that a company has delivered a biodiversity credit that is purely additional to what it is that they have in the way of negative impacts. The second issue, as I mentioned before, is that you need to make sure that your links to the underlying biodiversity are solid. And that's to say, you need to show that if, for instance, you're working in a particular ecosystem, that your uplift for that ecosystem is actually something which is independently verifiable. And there are some standards now which are demonstrating how this can be done. The Vera organization has produced some guidelines about how this can be done according to a set of standards. But it's very hard to do this in a standardized way across all the different ecosystems in the world. It's easier to do for species because the knowledge of how it is that species are threatened is much better documented, and you can define what it is that is causing species to become at risk of extinction in particular places, and thereby deal with the threats that apply to those species in particular ways, and generate a quantified change in the extinction risk of those species. At the moment, there's a very important problem, and that's the lack of demand. If particularly you're talking about biodiversity credits that are additional to the mitigation hierarchy. This is because it's not obvious to companies why it is that they should be buying biodiversity credits. So in a parallel with the voluntary market of emissions reductions, there is a presumption that if you are a company that is looking at potential future regulation, you might want to buy some biodiversity credits to sort of keep in your account in case you have to then demonstrate that you've offset or compensated for your impact somewhere. But as I said, there's a problem there with issues relating to the mitigation hierarchy that haven't been resolved yet. The total value of the market, the voluntary market for biodiversity credits is not very big outside national level regulated markets such as the UK or Australia or Colombia. The regulated, the voluntary markets is probably quite small, a few dozens of millions of dollars per year. So that's going to have to increase enormously if we are to be seeing a flow of finance to conservation projects that is actually going to correspond to the gap in biodiversity financing. The issues of market and regulation are fundamental to that. There has to be a market that is regulated and international for this the biodiversity credit process to really generate the revenue you need. There is very little perception currently that there's a market, such a market is available for the reasons I've given. There is currently an opportunity for markets to develop in places such as the UK where there is a regulation, but those regulations are generally speaking only domestic. They're not applied internationally. So you need to be able to find a way for the principles that apply to biodiversity credits to be applicable across boundaries. And that's not something there's an obvious case for at the moment. Another really big issue is whether you can, if you generate a biodiversity credit, whether you can sell it on a secondary market. And there's a lot of resistance to this happening because as the value you generate in a secondary market is acquired, very little of that extra value then passes back to the people who generate the credit in the first place. And that leads me back to the issue of indigenous people and local communities. In order for biodiversity credits to be the solution to the funding gap in biodiversity, you have to be able to create a biodiversity credit that is integrating the values and the perceptions and the engagement of the people, in many cases, who actually own and manage the biodiversity assets on the ground. And that means you have to deal with things that go way beyond a formula contract. You have to be dealing with governance and equity principles that are, in some cases, very difficult and complicated to formulate and to negotiate. They are often very specific to specific communities, and the transaction costs of setting up those agreements are very high. So it's quite likely that there will be a reluctance on the part of investors to cover those transaction costs in order to engage IPLCs in a biodiversity credits market. And that's been a source of considerable resistance by the IPLC community to the process of being engaged in biodiversity credits as they stand currently. Same thing really applies to land-based emissions reductions credits, or there's been a lot of work on figuring out how benefit sharing approaches can be developed in those cases. The last two, actually the links to underlying biodiversity and the involvement of indigenous people and local communities is something that IUCN is very preoccupied by. We've been trying to make efforts to define how it is that biodiversity credits should be dealing with those issues. And we've got some initial perspectives on this, but it's certainly the case that the process of making biodiversity credits into a tool that will enable large-scale funding to come to biodiversity conservation outcomes, we're quite a long way from that at this point, I would say. Thank you.
Thank you very much, Frank. And there is a lot of material on the table, and we can see it already from the questions and the comments. But before we take some questions, we have perhaps I can turn back to Magda for just a few more additions, and then we'll have roughly 10 minutes for questions. And I'm hoping that we'll be able to take at least 2 batches of 3, or at least 1 batch of 3. And I will try to cherry pick because many of the points that are on the chat are comments as well. Magda.
Thank you, Jorge. So as I previously mentioned, I would like to just add, building on that, a couple of words about what is going to be discussed and explored in the IUCN Academy Professional Certificate on Finance for Nature. We analyzed the 4 main aspects that link of the link between nature and finance during the course. In the first one, we explore the concept of nature as a natural capital asset and its significance in the global economy. In the second module, we dive into the governance frameworks and how nature-related financial risks can be identified and regulated. We next move on to assessing the existing data gaps and related challenges. And we close with reviewing a range of financial instruments of change that can be used in this context. And as I mentioned previously, the fourth edition of the course is going to start on the 13th of January next year. And it is a 5-week long adventure with a blended course where the participants study self-paced material provided on the IUCN Academy platform and meet weekly with Jorge and different external speakers with whom we dissect the relevant concepts. The participants also work on a group assignment over the length of the course, which they then present in front of the entire cohort of the course. And individually, each participant throughout the length of the course works on a personal assignment, which allows them to get more of a practical and hands-on relationship with the material of the course. So we invite you to explore this possibility, and we will be happy to welcome you at the beginning of next year. Thank you for this, and I will give the floor back to Jorge to moderate the discussion that you might want to have after the presentations. Thank you.
Thank you very much, Magda. And there are quite a few questions and comments. I will try to group them because otherwise we will not be able to capture most. But there is a bunch of questions, comments that are about integrity. Essentially, what are the methodologies, or how robust are the methodologies to ensure that what is being achieved, I mean, the outcome is genuine. And there are many different aspects of that question that was asked by at least 3 or 4 people. So this is one to put on the table. The second to put on the table, I think, is the issue of the upscaling of carbon credit, of biodiversity and carbon credits or carbon finance in developing countries, given the fact that some of the building blocks may not be that readily available. And that's something that, again, it's been asked from the perspective of specifically developing countries, and some participants specifically mentioned that that could be an issue in Africa. And the third question is really about the upscaling of something that remains quite niche, which is this form of finance, and more specifically, not just the finance, but the financial instruments that can generate some sort of return to the investor, which is different from the usual, green bonds and that do generate returns, but that's in the form of an interest. But so that would be really the issue, and the question essentially suggests that unless you generate that return and that can be upscaled in some way, this will remain niche, and we may have to accept that this will remain niche. So I'll just stop with those 3 questions, and I give the floor to the 3 panelists, perhaps starting with Frank, and then Shizuka, and then Daniela. So we, as a matter of equality of treatment, so the last starts first, and so on. Frank.
Thanks. I wanted to address the question of the links between carbon credits and biodiversity credits. And I think there is a relatively simple starting point where biodiversity credits could be added to an existing carbon credit project. So this has obviously been pioneered for quite a long time by activities, initiatives like the Climate Community and Biodiversity Alliance. But I think the point we've got to now is that we can actually demonstrate that we have additional impacts on biodiversity that are generated by the same kinds of activities that generate carbon credits, but that create supplementary benefits to biodiversity. An example of this would be an emissions reduction, land use emissions reduction project that reduced deforestation in a developing country. I think in this case, you would generate biodiversity benefits from reducing biodiversity, but there may well be things you can add to the activities associated with reducing deforestation that will increase that value from the biodiversity perspective. One of those might be, for instance, adding to a forest loss reduction project, an initiative to reduce the level of hunting. Very often you get increased levels of hunting in areas that are being managed for various purposes, including forestry. And if the forestry is being managed in a sustainable way and thereby generating emissions credits, you could add to that a way to reduce the level of hunting, and that would increase the value of the project for biodiversity. And that supplementary component can be valued and could be created as part of an associated biodiversity credit. That's probably the easiest pathway you have currently to generate biodiversity credits in addition to the carbon credits, the land use carbon credits. But there are a range of other ways that you can do that. For instance, in similar kinds of things for threatened species in mangroves or in other wetlands, you often have very close association between conservation of carbon in deep peat and the value of the biodiversity that comes with those environments. So there's a range of different places where you can achieve the additional biodiversity goals with a project that starts out as a carbon project.
Thanks, Frank. Shizuka?
Yep. Thank you, Jorge. I want to touch on the financial returns and the question of national and international regulations. So it is true that currently the amount of investment that goes into nature is quite minor. That said, we've seen over the couple of years in the climate and carbon area that companies are increasingly interested in not just the financial returns, but also seeking for contributions to achieve their net zero targets. So it's become quite a norm that they have the companies have and investors have the net zero targets. So they will be incentivized to invest more into projects that would achieve it. And in a similar manner, if we transition into society and market where biodiversity, nature positive is a norm, then there will be more incentives and demand for investing in biodiversity positive projects. And so this is what the international regulations and agreements can make and make the market transition into such a incentive creating environment. But also, as somebody mentioned, the national regulations is also important. I've also been looking into African context, and unless the governments have the clear and consistent and long-lasting policy that they want to invite private sectors to invest in those sectors, then the businesses will not feel comfortable enough to set their foot on the sector or the country. So I do agree that there's an important step for the governments to take a role in creating and enabling and promising policies for private sectors to operate. Thank you.
Thank you very much, Shizuka. Daniela?
Yeah, so I'll briefly touch on how to measure impact and the metrics. So regarding the regulations that have just been and that has just entered into force, that's a big step, I think, into standardizing how to measure the impacts and how to integrate these into the company's business models. Of course, the regulations look also to increasing transparency and avoiding the pitfalls of greenwashing. Of course, measuring impact, though, and well, engaging stakeholders, which is also a big part of these regulations, also contributes to enhancing transparency. Then, of course, comes the actual problem of measuring the impact, that although I would say these regulations contribute significantly to standardizing and giving guidelines into how to measure, for example, water consumption or land degraded or invasive alien species, there are still steps to be taken into really measuring the actual impact of that companies have on the environment.
Thank you very much, Janina. Actually, just to wrap up, we have just 3 minutes. But one aspect to keep in mind is that sometimes the answer has to be more granular. In that it's difficult to give an answer that applies to all sectors or that applies across the board. But just to give you 2 examples that are, quite standard. The insurance industry very much benefits from investment in nature because, nature creates resilience, for example, against floods and against other types of hazards that otherwise would generate more frequent payouts from the insurance company. So we see a lot in the insurance sector, a lot of care being and a lot of attention being paid to strict to data and to actual projects that can be improved from the perspective of resilience. Another example is investment in certain ecosystem services, in improving or enhancing certain ecosystem services that can generate or improve the performance of a company that is an investee. A typical example is a company that relies a lot on pollination. Pollinators are the unpaid workers of agriculture. And if you can rely on pollination and you can invest in ensuring that pollination as a service, or it sounds a bit strange to consider that bees and other insects are pollinating and are providing a service, but that's the map that has been developed by a number of organizations that have identified 22 ecosystem services, etc. But it's quite easy to see the direction and the link between investing in that particular type of service and the financial income. Third example, water companies, not utilities, but bottled water companies that have to invest in the quality of the water and cannot modify the quality of the water that much after it has been extracted, because otherwise they cannot brand it with the same label. And that also requires investment in some forms of nature conservation and removal of certain chemicals that are used for agriculture. And that's an investment that has a direct return in the performance of the business. So there are many different ways in which this can be done, and that's what is difficult. And I think, and this seminar has conveyed that quite clearly, is that what is difficult is to have the big picture, to have the big picture, not to get lost in the jungle, to use a suggested term. But thank you very much to all the speakers for sharing their expertise, and thank you very much to all the attendees for their questions, comments, and time. And hopefully you can get in touch with Magda if you have any further questions or queries. Have a nice morning, afternoon, or evening, and take care.
Thank you very much. Goodbye.